In this video, I want to look at some long-term trends. So, over the last 20 years, the Fed has stuck to this monetary policy, cutting interest rates to zero or near zero and holding them there too long, and it has consistently produced one bubble after another. It seems logical to me to expect that since they are continuing that policy, that we should probably get another bubble or a couple of bubbles. So you can see what happened here in 2000. Greenspan kept rates too low, too long, created a bubble in the NASDAQ. The bubble pops, we have a recession. They return immediately to that same game plan, cut rates to near zero, hold them there for several years. Money's too cheap. It creates another bubble. This time it's in the real estate markets. That bubble pops. The money flows into the commodity markets, focusing on energy. Then we get a bubble in the energy markets, and then we get the short deflationary period where we have a recession. Everything collapses. The Fed returns again to that same policy, cutting rates to zero, and they've held it at zero for 7 years, 5 years, I guess it was, almost 6 years. And now they are very slowly starting to raise rates. So they're repeating the same mistakes over and over. It stands to reason that if they keep doing the same thing over and over, they should continue to get the same result. And I think it's pretty clear that they are going to get the same result. I think the stock market has started its final bubble phase. So you can see here, before a bubble begins, we usually have a very scary shakeout. In the last bubble in 2000, the shakeout was the 98 Asian crisis, long-term capital management. The stock market had a severe correction, came down, tagged its 200-week moving average, and then that was the springboard to launch into the final bubble phase. Same thing happening here. As we started to roll over into this big correction in 2015, 2016, many people were calling this the beginning of a bear market. I was one of the few people that knew that was incorrect. This was never going to be a bear market. Bear markets almost always start as a left-translated multi-year cycle. And you can see here that this multi-year cycle in the stock market was extremely right-translated. Not even close to being left translated. So this was never going to be a bear market. It was just going to be the correction to come down, test the 200-week moving average, and that would be the springboard for the bubble phase to begin. And it's pretty clear that it has begun. So I think we're going to follow the same path we did in 2007 into the top in 2007 and then 2008. And by that I mean when the bubble in the real estate market topped and then started to roll over, it took the stock market with it. And then as you can see this here, if you remember, we had a big kind of a semi-crash in February when the Shanghai market had I think it was a big 6% drop in one day. That was followed by a big move down in the U.S. stock market. This is when the banks topped, and then we started this megaphone topping pattern here. Another move to new highs. Big sharp correction comes down to test this low. That was a sign that something was wrong. And then the double top. And then as the housing market really started to unravel, the stock market rolled over and began its bear market. So as the liquidity was coming out of real estate and the stock market, all of a sudden it was hard to make money in the stock market. It wasn't consistently going up anymore. It was starting to gyrate violently back and forth. It became hard to make money in the stock market. So liquidity started to leak out of the real estate market and the stock market, and you can see where it flowed to. was looking for something that was still trending, and that was the commodity markets, specifically oil. And that liquidity flowed right into the commodity markets, giving us the second bubble focusing in oil. So then we have the recession, a brief deflationary period here where everything collapses, and then the Fed goes right back to that same game plan. They cut rates to zero. They hold them there for years, and as expected, it's going to create another bubble. I think it's going to create two bubbles, similar to what it did here. I'll explain in a minute, but you can see that the stock market is doing the exact thing that would be expected as a bubble matures. We've got our scary sell-off, test the 200-week moving average, and then the market has really started to accelerate to the upside. And so, as I've been saying over and over, once we got this breakout above the 2000 high, it's my feeling that the bubble phase of this bull market, we're easily going to get to 10,000. This is a huge consolidation over 16 years. We've broken out. You can see what the effect of this breakout has been. The market has really started to accelerate to the upside. I'll say it again, 10,000 is going to be a piece of cake on this breakout, and 20,000 isn't out of the question if we really start to get nutty in the final bubble phase. But I think what's going to happen is the same thing that happened back here. When this bubble pops, liquidity is going to let me center my screen here. Sorry about that. But I think liquidity is going to flow out of stocks and it's going to flow into the commodity markets. So now let's look at the commodity markets. So I'm pretty sure the commodity markets bottomed. Gold bottomed in late 2015. The CRB and energy bottomed in early 2016, along with the 7-year cycle low in the stock market. You can see here the yearly cycle low in 2016 held above the yearly cycle low in 2015. Same thing for oil. The yearly cycle low here in 2017 is held above the 2016 low. So I'm convinced that the bottom is in. And now the way commodity bull markets usually run is whatever leads the first phase of the commodity bull market usually does not lead the second phase. And you can see that is what is happening here. The first phase was led by energy and base metals. The second phase is going to be led by precious metals and maybe agriculture, but definitely precious metals. So you can see it's already, if you look at the long-term chart, you can see it's already happening. Energy has dropped at the 2009 bottom, and then again here at this 3-year cycle low in 2016. The energy markets and the CRB in general has dropped considerably. We even moved below this low here, even testing the early 2000 lows, whereas gold has held well above its last 8-year cycle low, and of course nowhere near the 8-year cycle low in the early 2000s. As a matter of fact, the correction, the bear market in gold, all it did was come down far enough to test this C wave top here in 2008, and I don't think there's any chance that we're going to go back below that support zone. I think this was the bottom. So gold is already signaling, if you're looking at a long-term chart, that it is much, much stronger than the rest of the commodity markets. And so I think when you do get our bubble phase, when the bubble phase in the stock market pops and liquidity starts to flow back into the commodity markets, I think it's going to focus on the precious metals, because I think we're going to have a currency crisis, probably focusing first in the US dollar, and I think that's going to drive a bubble phase in gold. So once we get a bubble and it pops in the stock market, I think we'll then get a second bubble that will focus in the precious metals. Very similar to what happened here, where we got a bubble in real estate that when it popped, then we got an echo bubble in the commodity markets focusing in energy. So over the next year, as the stock market continues and the bubble in stocks matures, I think the commodity markets will continue to trend upwards, not rapidly. I think it'll be kind of a frustrating, choppy back and forth move, but I think they will trend generally upwards. I don't think we're going to go back below any of these major lows, and that will set up the commodity markets to receive the liquidity that will come out of the stock market when the bubble finally matures and pops in stocks. So I'm not sure if we've got our final low earlier in July in gold, or whether we've got one more leg down that maybe tests that triangle trend line in the mid to upper 1100s like I've been looking for. Coin toss on that one, but I don't think there's any chance that we're going back below this low that we put in late 2016. And then later in the year, I think we get another intermediate rally that will at least test 1400. It may even go high enough to test 1500 and test this support and resistance zone right here. And once it does, then I think we have our final confirmation that the bear market is over and that we've started another bull market in gold, and that we're just kind of stuck in a basing phase right now. Same thing with energy. I think we're just stuck in a basing phase that's just not getting a lot of upward momentum, because the upward momentum is focusing on the stock market right now, and probably will be for the next 6 months to a year. So the commodity markets, while they should be generally trending up, I think it's going to be a slow move, while the stock markets trend aggressively and maybe even violently higher.